Hey everyone, in this video we're going to take a look at the Chapter 12 homework problems and work through those together. So here we're just going to start on question 1, and a reminder that Chapter 12 is liabilities, so different types of liabilities like wages payable, taxes payable, so on and so forth. So okay, our first question says on October 1st, this company borrowed $600,000 from a local bank. The note is payable in equal installments over 6 years. Write the journal entry to record the note payable. So this is pretty easy. Cash, right? We're borrowing the money, $600,000, and then we have a liability that we're going to call, notes payable. Hopefully that's 600,000. It's hard without the commas. Okay, and how much of the note would be considered current on October 1st, 2025? So right away, when you take the note out, and really at any point, because it's 6 equal installments, so 6 installments would be 100,000 each, dividing 600,000 by 6. And so the current portion is the portion that's going to be paid within 12 months. And so it'll always, because we're paying the same amount every time, every year, you're still paying the 100,000. So 100,000 would basically always be the current portion. And then at this point, the non-current portion would be 500,000. Current portion, 100,000. Okay, on January 1st, this bank lent this company 68,000, and they signed a 10-month, 12% note. Okay, so then, kind of the same thing. So cash goes up, notes payable goes up, so liability up and asset up, and it was 68,000. And then it looks like, what do we say here? Oh, it's 10 months. So 68,000 times 12% is 8,160. That would be for a whole year. And then we can divide that by 12, so it becomes 680 per month. And we did this on January 1st, and November 1st is when we are repaying. So it's 10 months. So we have to take the 680 times 10. Again, 68,000 times 12% is 8,160. Divide that, that's for annual. Divide that by 12, gets 680 per month. And then multiply that monthly amount by 10 to get the total amount that we would have to repay, basically, right? So we're paying back with cash, right? So we're going to have that additional interest portion of 6,800, and then we've got 68,000 is the note payable going back. So it becomes 74,800, and we're going to recognize interest expense and alphabetical order. Okay, so I think we need interest expense first, then, and then notes payable will be reduced to 0 because we repaid, and then 6,800 again is 68,000 times 12% to get annual. Divide that by 12 is 680, and then times 10 gets us 6,800. All right. Move on to the next problem. Question number 3. Okay, so we've got kind of an unearned revenue type transaction here. So a transit company passes are 176 each. What is that? September to just the end of December. So it's September, October, November, December. So 4 months. So $44 per pass. And where do we go? Oh, $44 per month. Okay. So 176 is 44 times 4 months, like I said. So if we sold 1,300 passes, so 1,300 times 176 equals 228,800. So cash goes up, And remember, it's unearned revenue at this point because we haven't earned it yet, even though we have the cash. And then we're just recording 1 month's worth of the total. So per month, if it's 4 months that is being recorded, right? These are good for 4 months. So the whole 228,000 will be earned over 4 month period. So we just have to divide that amount by 4, and we get 57,200. And that's us, that's 1 month's worth of revenue, essentially, right? And so what we're kind of assuming in this problem, I guess, too, is that we already recorded the same entry in August, right? That would be more typical too, because I think some of the homework problems said something to the effect of, record multiple months at once of revenue earned. Well, excuse me, but typically you would just record it on a monthly basis like we're doing here. Okay. All right. So Salim Enterprises, graphic design company. Okay, the account needs to prepare journal entries, salaries, deductions, and contributions. Okay. So here we see gross pay of 44,600. I'm just going to be typing this in my Excel off to the side. So gross pay is 44,600. Employee contributions to retirement savings is 1,300. And then we've got federal income tax, state income tax, FICA, FUTA, and SUTA. So a reminder, this is employee only. These FUTA and SUTA are employer only, and then the employer and the employee both pay the FICA taxes. And then we have the retirement savings plans, which is just taken out of the employee's pay. So with that said, let's fill out our journal entries here. So we have salaries expense for 44,600. And then we got to go to alphabetical order again. So we have got, geez. I'm going to put these in my Excel and organize them by alphabet. It's kind of a pain. So federal taxes, state. This is for the employee, right? So they have federal, state, FICA, and they have a retirement. We'll call it. I'm just going to say 401k. There's other types besides 401k, but it's easier for me to type that in. So we have 1, 2, 3, 4. Yeah, that should be all 4 of those. Sorting these in alphabetical order. What do they call it? Retirement savings. Okay, no, I do need to have it be the same name because otherwise it won't be in alphabetical order correctly. Just kind of a pain. Okay, so I think we've got federal income tax payable, then we've got FICA, then we've got retirement, and then we've got salaries payable, and then state income tax. The hardest part of this for me is just putting these in alphabetical order. Okay, and so the rates that we have, so we have 44,600. The rate is 9%. So we take 9% times the 44,600. So I get 4014. Okay, and then for FICA, it's the 44,600 times 0.0765 or 765%. Round to 2 decimal places. Okay, so I got 341190. Retirement savings, it just told us was 1,300, so we're holding that for the employees and sending it to their, our investment company, retirement plan company that we work with. And the state income taxes payable is what, 6%? Okay, so 6% times 44,600, which is 2676. And then we got to find the difference between all these. So 44,600 minus 4014 minus 3411.9 minus 1300 minus 2676. 33 1. Okay, so then you get salary. So the residual portion of the salary is payable. Then it's 33,100. Yeah. Okay. And so it's a little weird, out of order, kind of, I think, because usually the salaries payable is the bottom line, and it's everything here minus the deductions. But whatever. It's how you have to do it for the software, to recognize it with alphabetical order. So. Okay, so here it says use the data above and assume that the company has a match for the retirement plan, and so that will be the same amount. And we'll say employee benefits expense. And again, we're going to have kind of a similar, we're going to have FUTA and SUTA. We're going to have FICA. We don't have any income taxes here for payroll because that's just related to the employee stuff. Okay, so I think we have FUTA, retirement savings. What am I missing? Oh, FICA. Shoot, FICA is the first one. FICA, FUTA, retirement plan savings. And then what's the other one? SUTA? Yeah, we didn't have SUTA in there. Okay, so then we got to go back to our percentages. So the FUTA percent is 0.6%. Be careful with the decimal there and the percentages. It's not 6% or 60%. It's 0.6%. So you got to put a bunch of 0.006. I think that's extra zeros there. So I take, wait, which one did I just do? That was that was the FUTA. Okay, so FUTA 267.6. So we're multiplying 44,600 is what we're multiplying everything by in order to get our totals here. So for FICA, it's the same thing. FICA is always a match between the employer and the employee. The payroll, the retirement savings, it tells us in the problem that they pay the same amount. They match our amount there. And then SUTA is 5.4%, and multiply that by 44,600 gives us 2408.4. And then if we add all these together, what is it? 7387.90. Let's check our numbers. All right, 100%. So, yeah, a few things to remember. Just you're multiplying all your percentages by the total amount paid. The salaries, expense in total. FICA is paid both by employer and employee, same amount. It tells us that we're matching the retirement, so that's how we knew that. And then, yeah, we just multiply. And then the residual portion after you take out all the deductions is the salaries payable. That's the amount that the employees are actually going to get paid in their paychecks eventually. Alrighty, question number 5. So in question number 5, this company sells heavy-duty lawnmower equipment. On May 12th, they sold a lawnmower for $45,000. Wow, pricey. Includes a 4-year unlimited warranty. We estimate it'll probably be $4,600 paid out in warranty obligations. Yada yada yada. Okay, so we didn't do this one on the workbook exercises. I kind of thought there was enough in this chapter without the warranty stuff, but this is a good little touch on it. We won't have. It's relatively straightforward, I think. So we're selling it on account, right? So we're going to do sales revenue and AR, nothing different there. Again, we got cost of goods sold and our inventory going down. Made a pretty good margin on this expensive lawnmower. And here's the part where we need to think about the warranty obligation then. And so what we do is we essentially record warranty expense right when we sell the thing, and then we say estimated warranty liability, and it's got 4,600 is what we calculated. And that's basically how we do it. Sometimes it'll say, we estimate it's going to be 2% of sales or something to that effect. So the journal entries will look real similar, just warranty expense and warranty liability. But the base that they use to calculate it, the factors might be a little different than it just telling you. But that's what this one did. So maybe we'll see another problem like that. That makes us do a little more work. But let's see. Okay. So this one says that we purchased a truck, cost $100,000. Okay, so we had to do a note for it, and we need to do all the journal entries. Okay. So we're getting a truck, right? Is that what it is? Yeah, truck, and we incurred a note payable for it. I think that's the account they want us to use. And so we're purchasing the truck, not with cash, but with debt, basically, right? So now we owe $100,000, and that was on January 1st. What are we doing here? December 31st. Okay, so it's a 1-year note with 6% interest, and we're gonna just record the whole interest expense at the time of payment. It's 6% on 100,000, or that's 600, I think. Right? Oh, sorry, 6,000. That makes sense. Okay, so we're paying cash, right? We're gonna, if we pay the 100,000 back plus the 6,000, we'll be paying 106,000. The note payable is gonna go to 0 with the 100,000 payment, and then interest expense is what we're gonna record for the other portion. Oh, I probably have to put that in order. Second thing, interest expense. And then note payable. Gotta watch out for. There we go. Oh, and I forgot a 0 or something. There we go. Okay, so pretty basic note payable type problem. This one we got, instead of getting cash, we got a truck, and financed the truck essentially that way. So a lot of times we see notes payable related to cash, borrowing bank loans and stuff like that, but not in this instance. Oh geez. Okay. We got a bunch of inventory transactions to record in this problem. So we buy and sell home appliances. We have a year end of December 31st. Okay, so we purchased vacuum cleaners worth $66,000 on account from a wholesaler. So we've got inventory going up, payables going up, and 66,000. And we're not we're buying it from a wholesaler and we're going to sell it again, right? And so when we're talking about sales tax in relation to these problems, we, as the retailer, the customer, the final customer is the one who pays the sales tax, basically, right? So if that's what we're even doing that. Oh, this is just warranty liability issues. Okay, it doesn't even talk about sales tax in this one, which maybe it should, but that's fine. Okay, so then we sold the vacuums here to have cash and sales revenue, just like we've done always, 31,000. And we're going to record our cost of goods sold, just like we've always done. So nothing really new there. It's just telling us what these amounts are. And then we record our estimated warranty liability. So we have expense and a liability for 23,000. Okay. And then what did we do? We paid the amount to the ex-wholesalers. So now we owed, what do we owe them? 66,000. So AP will go down by 66,000. Okay. Is that B wholes? Oh, X wholesalers. Oh, wait. Who's V wholesalers? Is it X? Oh, what the heck? Oh, yeah, I think they just have a typo there. That's weird. Whoops. Okay, so 66,000. Let me make sure that's right. Okay, yeah, it just says V wholesalers, but up here it says X wholesalers, so whatever. Okay, to record utilities expense, what is this? Utilities bill, 3,600. So this is just kind of practice. Remember, accounts payable is our liability. I guess this chapter is about liabilities. We've already been dealing with these accounts payable and things of that nature for a long time, so hopefully this is not too tricky. And then we pay the bill, right? So we got our payable getting debited to go to 0, and then we're crediting cash to pay that off. And then we received 31,000 for the sale of vacuum cleaners. So this is an unearned revenue type of transaction. So we got a deposit. How much was it? It was 31,000. So a customer paid us a deposit. And until we actually deliver the goods, it's unearned revenue because we haven't actually completed our part of the whole transaction. But now we do down here. This is us recording actually delivering the stuff. So now we actually get to count it as revenue. So we get rid of our liability by debiting it, and we record revenue by crediting. And finally, cost of goods sold was 9,300. Is that what it's 9,300? Yeah. So then we can just do our same old 9,300. Okay, that's all the transactions there. I thought they might throw a sales tax deal in there, but no. Okay, but this one does. So we got 8% sales tax. We've got $3,800, and 3,800 times 0.08 is 304, and then 5,700, and 5,700 times 0.08 is 456. Okay, so 304 and 456 is going to be our sales tax amounts. And so we're gonna, okay, so we got cash, sales, I got RQRST. Okay, revenue comes first then. Yeah, okay. So sales revenue is 3,800. Sales tax payable, like I just said, is 304. So multiplying 8% times that. And then the cash, the summing those together gives us 4,104. And then we've been doing a bunch of these COGS entries. So it's just cost of goods sold as an expense, merchandise inventory going down. And that's 2090. And then sales on account is the same exact entry basically, except we're going to do AR instead of cash. I'm just going to put these in. This is the same thing here, but it's 2,800 for cost of goods sold. It's 50. I want to make sure. Yeah, okay. Alphabetical orders making sense. Okay, so sales revenue is 5,700. Multiply that by 8% for the sales tax piece is 456. And then adding those together is 6156. Sweet. Okay, that's everything there, 100%. All right, and we're on to the last problem here. And now sell outdoor furniture. We have 5% sales tax, and we had some transactions here. Okay, so real similar to what we just did. We're selling this on account for this first one. Gotta remember which goes first. Sales revenue then was 5,200. calculations here, and it was 5%. Okay, so then 5,200 times 5% is 260. If you add those together, the total amount is 5,460. The cost of goods sold and the merchandise inventory was 3,900. Okay, and then this entry is cash, not AR. But we're going to do the same exact accounts here. So COGS, inventory goes down. It was what, 6,900 for sale. That was the revenue we earned, and then 345 is multiplying that by 5%. The total of those two is 7,245. And then cost of goods sold, it says is 3,680. And okay, so then we get paid. So that's them paying us the AR balance. Oh, did I do that right? Okay, 5,460. There it is. So cash, we get our AR coming in. So accounts receivable goes away. We say thank you very much. And then we remit the sales tax amounts later. So we send this to the government and we get rid of our payable with a debit, right? Sales tax payable goes away, just like accounts payable would or some other payable, right? And then we pay it. Cash goes down, payable goes down, and we've remitted the sales tax to the government, essentially, on behalf of the customers, or to customers in this example, essentially. So hopefully pretty familiar from doing inventory and just general transactions for receivables and revenue and cost of goods sold and expenses and assets and all this stuff. But we all add in more of the real world nuance of things like sales tax payable, because that is very much a real thing that real businesses need to account for. If you don't account for it correctly, the government does not appreciate that. So job security for us accountants, basically. So nobody enjoys paying taxes really, but as far as a perspective from a more optimistic or positive perspective, is that you gaining these accounting skills, there's lots of jobs where accountants are needed to make sure that sales taxes are being flown, and all the income taxes, whether you're a CPA preparing tax returns or a government IRS auditor making sure that people are paying their taxes right and businesses are paying their taxes right. Lots of job security in taxes and all these kind of different concepts. So, all right. Well, thanks everybody. That brings us to the end of the homework for chapter 12. Hopefully that was helpful. And as always, reach out if you have any additional questions, and I will see you all soon. All right. Thanks everybody. Have a good night.